Alright, and here we are again now with the investing classroom and how to secure yourself financially, right? Or to improve your financial literacy. Now, because this is only for video content, okay? So I slowly, as I read on these first two courses, staying investing in the market, that look at the things to know, the TLDR, uh, stocks has provided the highest return and increasing the wealth over time. Investor must have discipline and patience. Holding on can pay off in the long run. Holding on stocks or bonds, and again by looking at historical data. And after the end of a recession, small stock on average has provided the highest return or the cumulative return more than the large stocks after 1 month, 6 months, a year, and 3 years after the end of the recession. And then I look at the history of interest rate. So what is an interest rate? A simple example of that. Uh, what is the loanable fund market? This is much like uh, a market where buyers and sellers, here are the borrowers and lenders, ask loans at at your close uh, circle. It can be within your family, your parents, your brothers, sisters, and friends. Uh, However, when things start to get large and when at scale, uh, so governments and corporations, they do that using a financial institution, such as banks or any other institution. So this loanable fund markets, where you find loans of different risk and time lengths, plus different interest rates, reflected in different interest rates. So the Fed, since they were created uh, in 1913 by the U.S. Federal Reserve Act of 1913, they have a couple tools to regulate the economy, right? So I look at the example of short-term interest rates, such as, and by short-term, we mean is 1 year or less. So short-term example of interest rate, Treasury bill, government bonds, uh, uh, or yeah, government bonds with 1 year maturity, and the federal fund rates. So this is the rate at which commercial banks lend fund each other overnight. And the other mechanism that the Fed has to regulate the economy, slash control, slash manipulate, whatever you call it, are the discount rate, the rate at or the interest rate at which commercial banks ask for short-term loans to the Fed, and the prime rate, which is the interest rate at which commercial banks set to their most credit-worthy clients, usually corporations. So ultimately, the Fed wants to control the interest rates by buying and selling government security in the federal open market. So, much like the stock market, the bond market is also affected by the state of the economy. So the interest rates on bonds reflect is the demand for loans. So during an economic contraction, uh, the demand for loans falls, also the interest rates to stimulate consumer spending. And during an economic expansion, demand for loans increase as their interest rate. So I look at the I look at market contractions and expansion. This is the second model, the market downturns and recovery. By looking at this graphical and historical data, especially for long-term investors, or especially for investors who have a long-term horizon, uh, such as retirement. So by looking at this data, it is important to see how the market performed and how risk decreased over time. You know what I mean? So with that, okay, uh, as I look at the market contraction and expansion, and especially is the last 49 year of that, starting from 1973 to 2001, and see that that has happened 10 market contractions, and that ends or that indicate a market contraction indicate is a market stock cycle, a complete round a complete round of a stock price fluctuation, and these contractions may vary in time and length. So the contraction is defined as when the stock market falls from its peak 10% or more. Again, this is technicism, right? Important technicism, because this will help us to see when we are in the market. So when we have uh, assets in the market, right? So we have skin on the game, basically. And the expansion measure is the recovery of an index, and the recovery mean is the upswing or the boom of price security following a long decline. The term is also used to describe the nations or the boom nation's activity economy. So the expansion measure is the recovery of an index, and an index is, in the context of finance, is a statistical reference of investment expressed as a percentage in a period of time. So the whole idea of this is to measure progress. So since the recovery since the expansion measured the recovery of an index, uh, at the very bottom from its previous peak, and then the subsequent performance until a next level peak before 10% decline. That the things to know of that is investors who have a long-term horizon must allow their investments to grow. In this case, is quite obvious, especially here. Okay. So investors should have a long-term or investment horizons to allow their investment to grow. Kind of the, kind of the, if you don't know that, but showing this historical data so makes a case for that. And then I look at the market downturns and recovery. So again, looking at this historical data uh, to see and get a better picture of the potential market performance by looking at the U.S. equity market. The equity is the total amount of assets minus its liability as one definition. The total net worth of a company, the share you own from a company as stocks, okay, that might be one definition, uh, and the property value minus its liens. And liens are rights of someone else to possess your assets until a debt is repaid or an obligation is met. An example of liens you have is house liens, mechanical liens, real estate liens, tax liens, uh, and so forth. So, what does it mean with this is, for example, if you're not paying your taxes, okay, the government can seize your assets based on this right that they have. Okay, and not only the government, it's also someone that you ask for a service, and if you're not able to provide that, for example, mechanical is another way. You you give your car because they have some issue with their tires and the alignment, and if you don't pay them, they can hold your car until that is paid, right? So that's an example of what is a lien, or in Spanish, a gravamen, un gravamen, a lien. All right, cool. This is it's interesting to understand this as well. So the U.S. equity market has passed through several downturns, and the most severe start at the 1929 with the market crash, with the stock market crash, when stocks lost over 80% of their value, specifically 83.4% of their value. So imagine that you have a coffee from Starbucks, okay, and suddenly you only have is one finger of liquid, right? So one finger of coffee, your so your cappuccino, things like that. Oh, you son of a. And the recovery period was over 12 years. You son of a. 12 years. More recently, in the early 2000s, the dot-com bubble, stock lost 44.7% of their value, and it took 4 years to recover. And in 2008, during the banking and debt crisis, it lost 50.7%, and the recovery side was over 37 months, roughly 3 years and 1 month. So we're talking about, yes. So those recovery has shrunk vastly, but in the reality of things, so it's not the same reading historical fact as living them, because when you live that, it's totally different. Your psychology, your environment, your friends, your family, and the way how you react to that, all right, can be completely different of how you might think of that. So, for example, that's one of the interesting things about moving, when they challenge your own perception. Movies like The Purge, for example, you know. So when they challenged you, your preconceptions. Uh, so again, the things to know here is that stocks are prone to sudden loss in value for many different reasons. Political, economical, pandemic right now in the 2000 with COVID-19. So is this. So stocks are prone to sudden loss in value for many different reasons. So now knowing the market contraction and expansions and the downturns and recovery, now I look at that, but with respect to the asset class. And here is such as bonds, stocks, and other class along with some sample portfolio structures. Okay, and some yeah, and another class along with some sample portfolio structures, and also see the correlation of differing assets with a broader market. So by looking at bonds yield during recession, there are uh, several driven factors like supply and demand, monetary policy, and inflation. And since the Fed has, as it is primary tools to regulate, to implement monetary policy, to regulate the economy, is the federal fund rate. Again, these interest rates that tell uh, the interest rate at which commercial banks lend from each other overnight, and the that's the federal fund rate and the discount rate. These interest rates charged to commercial bank when they ask for loans, when they ask for short-term loans. And during recessions, explaining this a little bit more or elaborate this. So during the session, the demand for loans fall, and the Fed lower interest rates to stimulate consumer spending. And during expansions, the Fed during contraction, okay, or during recession, or during recessions or contraction, the demand for loans tends to fall, and the Fed's lower interest rate to stimulate consumer spending. And during an economic expansion, the Fed may want to keep inflation in check and tighten the monetary policy by increasing interest rate. So short-term interest rates like federal fund rate, like the Treasury bills, have a close correlation with the federal fund rates. Interesting to know. Okay, so this short-term interest rate, like Treasury bill, let me look at this Treasury bill. Treasury bill rates, the current Treasury bill rate, interest rates, or the Treasury bill, Treasury bill rates for Nasdaq. Okay, right. So Treasury bill rates here. So the Treasury bill rates, okay, has a close correlation of the federal fund rates, according to this. Interesting. So Treasury bill have a close correlation with the federal fund rate. Okay, this is actually quite interesting and something that is applicable according to Morningstar. So if you want to know what is the federal fund rate, uh, looking at according to Morningstar, looking at the Treasury bill rates uh, have can give you pretty close what is the federal fund rates, meaning how the commercial bank lend fund each other. hmm So okay. This is the treasury bill rate, and if we look at the inflation, the interest rate, okay, and if you look at the interest rates, another definition, thanks. From treasury.gov. Okay, you're going to explain this definition. Now I want to look at the current interest rate. From interest rate to the rates to for space. Interest rates, US. Yeah, I have to be more precise. Um, Financial.yahoo.com. Okay, this is the actual domain. Fed calling sees US interest rate high peak just above 5%. Can you tell me what it is right now? I think right now it's exactly the Fed benchmark overnight lending rates currently sit in the target range of 40.25 to 40.5. Okay, 4.5, right? So 4.5, and this is the inter. Okay, and Treasury bill has a close correlation with the Treasury with the federal fund rate. So yeah, this is the rate at which commercial banks lend fund each other. This is like a superpower. It's like holy fuck! You can see now this interesting. Holy fuck! Completely, man. It's like holy fudge. Very very interesting. Okay, okay, okay. So the things that I know today was like this. What is the recovery? Uh, treasury, treasury bill have a close treasury bill rates. Okay, shorter interest rates like treasury bill. Okay, it's important. Yeah, short term rate, short term rates like treasury bill have a close correlation. Yeah, have a close correlation. Have a close correlation with the federal fund rate. Have a close correlation with uh, the federal fund rate. Okay, so short-term rates like Treasury bill have a close correlation with the federal fund rates. Rate that indicate what borrowed money will cost. Uh, no, rate that indicate rate rate for commercial bank lend fund each other. Rate for commercial bank lend fund each other is this. Mm, holy fudge! Okay, okay. It's quite interesting. It's quite interesting. Again, it's not the same, but it's have a close correlation with that. Okay. 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 Mhm. Okay. Mhm. Okay. 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 Treasury builder. Okay. So again, I'm reading this is to not only to memorize what I'm learning here, but also to understand is how this narrative is something powerful, especially if you're gonna talk to someone else, whether it's new to the field or a connoisseur or an expert. But it's like that. Mhm. So okay, so bond yield during recessions are driven by factors such as the demand supply for loans, interest rates or monetary policy, and inflation. So since the Fed has two primary tools to implement monetary policy, like uh, the federal fund rates and the discount rate. So during an economic contraction, the demand for loans tends to fall, uh, and the Feds lower their interest rate to stimulate consumer spending. And during an economic expansion, the demand for loan increase, okay, and the Fed wants to keep inflation in check and tightening monetary policy by increasing interest rate. So short-term interest rate like the Treasury bill have a close correlation with the federal fund rate, which the Fed targets through open market operation. Exactly. Which Feds target through open market operations que los federales apuntan mediante las operaciones en el mercado abierto. So short-term rate has been more volatile, whereas long-term rates, which have a maturity of 20 or 30 years, have been relatively stable and have taken longer to react. So short-term rate has been more volatile, okay, and that includes the federal fund rates, uh, the treasury bill, and 1 year maturity bonds, whereas long-term rates, which have a maturity of 20 to 30 years, has been relatively stable and have taken longer to react to change in economy. So, according to Morningstar, long-term bonds, so long-term bonds, like 20 to 30 years, have taken longer to react to economic change. All right. And then how bonds rates are affected by inflation. So if you remember what is bond from Investopedia, so bonds are unit of debt issued by governments or corporations uh, that can be converted into tradable assets. Interesting. So an example of that is like because you can think of a bond like an IOU between the lender and the borrower with details of loans and its payment. So if you issue a loan in exchange for uh, some assets, okay, uh, this is a way of how you can do that. You might not like it. That's another one. You may not like it, but that's how you do that. But in any case, so bond yields, especially long-term bond yields, are sensitive to inflation expectations because inflations can erode the value of the bond over time. If inflation expectations are high, because after all, can affect is the value of the bond over time. if inflation expectations are high, lenders require a higher interest rates to lend funds for more than the short term. Mhm. For more than the short term. Therefore, if inflation expectations remain high, long-term interest rates may take longer to drop. So, stop. Hold on. So, how bonds rates are affected by inflation? So, bond yields, especially long-term bond yields, are sensitive to inflation expectations because inflation can erode the value of a bond over time. If this is a promise, if this is exactly. So if I, as a government or as a Fed, right, uh, as a central bank, I issue bonds. Okay, I give you a bond, let's say 1,000 uh, at 5% interest rate a year, and the inflation, okay, and the inflation expectations are high, meaning that the lender is going to receive less. Lenders require a higher interest rate to lend funds for more than the short term, especially if the inflation expectations are high. Meaning that giving loans here, giving long-term or issue long-term bonds in this economy or in an economy such as Argentina, issue bonds for that uh, is not for the lenders, it's not a business, but for the consumer, for the borrower, it's totally it is, totally it is, you know, totally it is. As long as those borrowers can be efficient with their resource and things like that. If inflation expectations are high, lenders require higher interest rates to lend funds for more than the short term. Therefore, if inflation expectations if inflation expectations remain high, long-term interest rates may take longer to drop, even during periods when the Fed is cutting rates. In the long run, interest rates could be even rise instead of fall. Exactly. Therefore, if inflation expectations remain high, long-term interest rate may take longer to drop. Again, since I'm reading here at Morningstar, which is a text-based with no real interaction with the market and stuff like that, it's kind of hard to understand this from a practical, yeah, from a practical point of view. Uh, but what I can see here, or what I can get from all of this, is uh, the things to know is that there has been a general decline of rates since the recession in 1982. Although interest rate has generally dropped during recession and rise during expansion, okay, exactly. Interest rates generally drop during recessions and rise during expansion. There have been a general decline of rates since the recession in 1982. Prior to that, interest rates were driven up because of the oil price shock of the 1970s, as the Fed aggressively purchased a strategy to lower inflation. Interest rate begins to fall and actually reached unusual low levels recently. Keep in mind that bond yields and price move in opposite directions. This is something interesting here. So keep in mind that bond yields and price move in the opposite direction. Bond yields and price. When yields for new bonds fall, existing bonds with higher yields. Okay. When yields for new bonds fall, okay. So when the returns for new loans or bonds or debt, right? So when the return for new debt fall, existing bonds with higher yields, with higher returns, become more valuable and can demand a higher price. And can demand a higher price. Mhm. Conversely, when yields for new bonds rise, the price of existing bonds fall in order to compete with the increased demand for new bonds. Mm, let me pause here. Let me. Okay. Hold on. So keep in mind that bond yields and price move in opposite directions. So when the yields of for new bonds, and here is when yields the returns, okay. So when the yields for the return for new bonds fall, bonds with existing bonds, existing loans, existing debt with higher yields become more valuable. Let me look at the bonds here. Bond US. Exactly, that bond. Mm-hmm. Treasury Direct. La, la, la. Series EE saving bonds. 30 years bond. 4,000%. This is 4,000 or two? No, this is 4%. Exactly, this is 4%. Issue price per 100 is 107 for 30 years bond and 10 years note. Series EE saving bonds. For saving bonds issued November 1, 2022 to April, but this is short-term interest rate. In Series 1 saving bonds, for saving bonds issued November 1, 2020 to April 30, 2023. You know what was the fun thing of this is that because most of the time people rely on this quick scheme, quick rich scheme, they forgot to be competent with themselves and understand how all of this and understand the nature of the game. Most of them do not understand is the nature of the game. Most people that play those games, those short-term, those quick rich scheme, those people that play those quick rich scheme, perhaps they understand that and they don't care, or they don't understand and ultimately it will pay off of the round something bad. Mm. What about saving bonds? Buy ones earn interest for up to 30 years. E-bonds guaranteed to double in value in 20 years. Guaranteed to double in value, to double in value in 20 years. You gotta be fucking kidding. Earn a fixed, earn a fixed rate of interest rate. Current rate 2 point. They are self-lose. Protects against inflation. Earn both, earn both a fixed rate of interest rates and a rate based on inflation. The rate is reset twice a year. Current rate 6.80. See, this is the current inflation rate. Like this, primary electronic, keep them safe in your Treasury direct account. You choose to use all of the power of your IRS tax refunds to buy papers and bonds. Maximum purchase each calendar year: 10,000 in electronic, one bond, and 5,000 paper for first bond. Can cash in after 1 year, but if you cash before 5 years, you lose 3 months of interest. You may have an older bond, but so I'm not looking right now at what is bond deeply. I'm just looking at the bond yield during recession. Okay, looking at this historical data and how bond yields, specifically long-term bond yields, are sensitive to inflation expectation because it can erode the value of bond over time. And the other is, yeah, even though the interest rate has generally dropped during recessions and rising during expansion, there have been a general decline in interest rates since the recession of in 1982 because of the oil price shock, the Yom Kippur War. So the petromonarchy made a oil embargo to the U.S. and the U.S. felt that. It was like, fucking hell. It was in 1970. As the Fed aggressively pursue a strategy to lower inflation, interest rate begins to fall and actually reach unusual low levels recently. Keep in mind that bond yields and price move in opposite directions. So when yields for new bonds fall, existing bonds with higher yields become more valuable. They can demand a higher price. Conversely, when yields for new bonds rise, the price of existing bonds fall in order to compete with the increased demand for new bonds. Two things to understand here. Besides the in bonds yields during recession, understand their driven factors: demand supply for loans, monetary policy, and inflation. Yeah, so the Fed used the federal fund rates and discount rates as its primary tools for monetary policy. So during an economic contraction, the demand for loans tends to fall, and the Fed lowered the interest rate to stimulate consumer spending. And during an economic expansion, the Fed wants to keep inflation at check. Okay. So the Fed may want to keep inflation in check and tighten monetary policy by increasing the interest rates. So short-term interest rates such as Treasury bills have a close correlation with the federal fund rate, which the Fed targets through open market operations. So short-term rates are more volatile, whereas long-term rates, like with which have a maturity of 20 to 30 years, have been relatively stable. So they have, or they take longer to react to change in economy. So understanding is that bond yields, specifically long-term bond yields, are sensitive to inflation expectation because of the risk, or because inflation can erode the value of a bond over time. So if inflation is high, lenders, okay, if inflation expectations are high, lenders require higher interest rates to lend for more than the short term. Therefore, if an inflation expectations remain high, okay, long-term interest rates may take longer to drop. So long-term interest rate may take longer to drop even during period when the Fed is cutting rates. In the long run, interest rates could even rise instead of fall. Again, this is because they're playing with this. So if the inflation expectations are high, lenders require higher interest rates to lend funds for more than the short term. And therefore, if the inflation expectations remain high, so long-term interest rates may take longer to drop, and long-term interest rates may take longer to drop even during the period when the Fed is cutting rates. So this is the one explanation that yeah, although interest rates have generally dropped, that has generally dropped in during recessions, in rising during expansion. So there have been a general decline of rates since the recession in 1982 because of the oil price shock or the Yom Kippur War, as the Fed aggressively pursued a strategy to lower inflation. Interest rates begins to fall and actually reaching usual low levels recently. So when they increase that, okay, when they increase even the long-term government bonds or the inflation expectations are high, they increase the interest rate aggressively during that oil shock. Mm, interesting. Interesting. Mhm. Okay. And with that, I'll see you in the next episode. Take care. Bye bye.